how to use equities to trade the Forex market. Now, what are equities? So equities are shares in a company, and we're going to look at the basket of companies that are put together to form the S&P 500, the basket of companies put together to form the FTSE 100, basket of currency put together to form the TSX or the ASX 200. If we're looking at Australia, we've covered how to use bond yields to trade this pair. So another added filter that you can add is how do we use equities to trade this pair? Pop over here on investing.com, and if you're not familiar with equities, then you can just click on here where it says indices. Major indices is what we're looking at. Okay, and you will pretty much get all the equities or indices depending on what you like to call them, but you'll pretty much see all the major indices in this chart. So for the US, we use the S&P 500 because it's a representation of the US economy. The first thing that we would do is we'd go back on the pound USD chart, and I just want to figure out how do I use equities? What did it tell me when I compare equities to my currency pair? What information do I get? Okay, so the first thing you would do is click on compare. This is going to be a little bit different from the bonds. Okay, so for the bond deals, we were just looking at the interest rate differentials. This time we're looking at the equity market, okay, and the correlation between the equity market and the currency market. So therefore, we're going to start with the ES futures. Okay, so that's the S&P futures divided by the UKX or the FTSE 100. Just depends on how you like to put it down. I put it down as a UKX. Okay, just go something more brighter. Okay, that's not too bad. So the first thing that we need to understand here as traders is we're trying to make it as easy as possible to trade. Trading is already a difficult endeavor, and we are trying to make it easy for ourselves to get into high probability trades, to understand what is going on when we enter these trades, to understand the themes that we're looking at, and also to just have a good understanding of a global fundamental picture, because this is what banks are looking at. This is what institutions are looking at. This is the themes that are played out day in, day out throughout the year. Okay, if we backtrack a little bit, we can look at the theme that played out last year was high US interest rates. That's why we have seen the movement out of equities and into the US dollar. So what we're looking at right now is equities being compared to currencies. Okay, so what this does, it also kind of gives you an understanding of value, but from the perspective of organizations such as pension funds, whereby they want the returns but are not willing to take the risk to get those returns. They are looking for something consistent, something stable. And as soon as any movement in the global fundamental perspective is against equities and into bonds, they will move their money straight away out of equities and into bonds. At the moment, as you can see here, right, we are still in an environment whereby the equity markets are valuing this currency just a little bit lower, but we can see that there is an aspect of higher highs and higher lows developing, which means that we could be moving into an environment of onboarding risk, meaning the equity market will be moving up. And as the equity market moves up, we're going to move out of safe haven currencies and into commodity currencies. Okay, so we can use these just to understand what are we looking at. For example, if I open this chart and I find that the equities are rallying, and there's a price divergence whereby the currency has not rallied, then I'll be looking for the currency to start turning, to rally or to drop according to how the equities are moving. Just an indication, not an indicator. Okay, it's just an understanding of how the market feels for the moment. So for example, if we're looking at the Euro economy, we'll be looking at the DAX because Germany is pretty much the driver of the Euro. Also, if we're looking at the US economy, we'll be looking at the S&P 500. Now, we click on that and we would input the ES1 futures. Okay, so the S&P futures divided by the DAX if we are looking at the Euro US dollar. We'll do a few currencies so that you guys can pretty much figure out what the formula for that is. First thing, guys, I always remind you, pin to scale or no scale. Okay, and change it to a color that will help you analyze quick in and out. Okay, so we don't really need to spend too much time on this. We just need to understand where are equities pricing this currency. We've seen how bonds are pricing this currency in terms of value. But now we want to see what the equities are doing. So far, what we can see is the equities have been dropping. This does not have to coincide with this because we're not looking at price action per se. What we are looking at is the overall theme. Are equities happy to take on a little bit more risk? Are equities looking to rally? So this is what we can see. But overall, how I use equities to trade is to understand whether we are in line with the theme. Okay. And this is what happens sometimes. You get a point whereby you're looking at equities, they are bottoming out, they start to move into your favor, or they start to move up where risk is on in the world and people are happy to take on risk in terms of equities. Price in itself starts to diverge from this equity line, and therefore we look for trades. Unfortunately, here we're looking at the COVID period, which is a very difficult time to trade, which was again subsequently made easier by the rally in equities, right? Which meant we were happy to buy commodity currencies and move away from a little bit of safe haven currencies. If we're not looking at the COVID period, overall, as you can see, it adds a little bit of value in terms of backtesting. Okay. If equities are moving up, they kind of coincide with price, and as equities are moving down, coincides with the price going down. So equities moving down would mean the dollar is increasing in value, and equities moving up would mean that we're happy to take a little bit of risk. If we looked at, for example, the Aussie US dollar, okay, so we would immediately switch this off and would now create a new chart that is the S&P futures, again, because we're using the US dollar first, divided by the ASX 200, okay? This is not an indicator, and it's actually pretty bad in terms of timing entries, but it's amazing in terms of giving you general direction of what we're looking at, okay? So this, alongside with the bond yields, kind of gives you an idea of what you should be looking at in terms of where we're hoping the price to be. And as you can see, it really does help in terms of filtering better and better trades. As equities start to increase, then that means there's a little bit of risk in the global environment, and therefore that coincides with the Aussie going up, all the commodity prices increasing. Do not use this as an indicator, but use it to kind of understand where we are in the world at the moment. You can see here equities have been moving down, meaning the price is favoring the US dollar as a safe haven currency, right? Now, what happens next year? And it seems as though equities are starting to bottom up here, but they have broken the lower lows, right? But price keeps going up. So this is price diverging while equities are still remaining down. And this could mean a trade opportunity, but we'd have to wait to see what the Federal Reserve tells us about the interest rates. If the interest rates are increased, then we can look at a move lower. The move could reverse to higher. And if interest rates are cut, then we'll be looking at a move upwards, okay? So we're pretty much always going to be looking for, as an investor, investors are always going to be looking for the highest return on investment, and they're always going to be looking to put their money where they know they can get the highest yield or the highest interest. We can try another one here, which would be CAD JPY, for example. Just going to compare. So we said the Nikkei 225. Always remember to start with that, divided by the TSX. Okay. Never depend on correlation. Always just understand that it's there. So it's something to look at in terms of filtering your trade and trying to see whether you can get better and better opportunities, right? But look at this. The relationship is really good here. Starts moving up. Equities start moving up. Supporting your trade to buy. Equities do not break the lower lows. Supporting your trade to add on to positions. So let's just look at whether there's any opportunities that we could have seen trades going. So again, equities moving up, price comes back, but right here, this would be a great opportunity to buy because again, equities are moving higher, okay, which means that you can go along with the trend. But this, remember, this is a day chart. So on all of these kind of strategies, if you're incorporating into your trading, the lowest I would recommend anybody to go would be the 2-hour chart. Otherwise, it starts to get really a bit messy, okay? But it does also kind of maintain its relationships. But 2-hour to 4-hour is where you'd have to kind of stay. That would be the sweet spot for most people here. As you can see here, the equities are dropping, telling you that you're not looking for price to break out. Equities are moving downwards, right, towards a risk-off environment. The Japanese yen, buying the Japanese yen here would be the safer move because equities are moving downwards, which means that price will eventually be going and following that as well. So this would be a great trade filter if you were looking to go long anywhere here and you already have the view that equities are moving down, then that would be a great trade filter for yourself. Okay, so that's just how we use equities. I will show you another one here, which is also really nice. New Zealand dollar and Japanese yen. So for this one, what you would do, you can use the Nikkei 225 divided by the New Zealand 50. Okay. Yeah, doesn't matter which one. I think, yeah, it's just TVC one. You can use that. Just look at it on the daily time frame. Again, always ensure that you print to no scale. Okay, because you just want to see the relationship, right? Again, just use something that we can see much more clearer. Okay, so now we're looking at this and we're like, well, this is definitely hugging price. Okay, this is a really good economic indicator to kind of show you. Look at that. Equities are moving up. The equity comparison is moving up. Price is more likely to move up. So it's really good in terms of filtering. But on this currency pair myself, I prefer using not this, but I prefer using the Dow Jones futures because they actually move also amazingly with the New Zealand dollar. Okay, it's a great kind of like relationship here. We can pretty much use the Dow Jones index to figure out obviously how is the sentiment looking like in terms of equities, pretty much comparing the equity market with the FX market and involving the equity market as part of our analysis on the bigger picture. As a trader, what I'm looking at is I want to be involved in trades not for 20 pips or 30 pips. I want to be involved in trades that are actually in line with the fundamentals, but I also get a good technical levels. And anytime that you're trading fundamentals, they're pretty much a little bit of leading indicators or leading economic indicators. So to help you understand what could be the possible direction of this currency pair. Then from there, if the currency pairs might be looking to move down, you're looking for premium prices, expensive entry prices, right? And if the price could be looking to be moving up, you're looking for discounted prices. And never be afraid for the market to leave because guess what? There's loads of other opportunities to re-enter the same currency pair as long as the theme remains the same. Okay. So as you can see here, if we were to, let's say, zoom in and just try to be, curve fit this in terms of risk, because from a risk perspective, you need to understand by looking at the currency volatility meter, you need to understand what currency pair you're in and what risk you need to be taking. Okay. So you can easily find that on, again, investing.com. Just pop over to tools, go on the currency volatility, look at the currency pair that you're trading, which is New Zealand Japanese yen. So it says on there that we should be at least taking a risk of 1.35%. It's 115 pips. Okay. If you're using that, or if you're using the ATR, which you can pretty much include on here, indicators, type in the ATR, and the ATR pretty much tells you where you should be placing your stop losses, or at least the indicator, the ATR tells you what range you're experiencing in terms of this currency pair per day on the day, whichever day you choose. So usually around 80 to 100 pounds. There's usually about 80 to 100 and 100 pips. Okay. So if you're looking for a one-to-one relationship, it will be safer to enter this trade at 100, maybe a 80 to 100 pip stop loss. So in terms of risk trading and in terms of longer term trading, 80 pips to 100 pips is not a big risk because all you have to do is adjust your lot size. Okay, adjust your risk management. If you take a standard lot, you are trading at $800, for example. If you take a 0.1, you're trading at $80. If you take a 0.2, you're trading at maybe $160, $170. So it just gives you enough room to be involved in the trade because trading has one concept, and that is remain in the trade. Okay, remaining in the trade, that means you need to have at least some skin in the game. If you're taking a sample size of trades, let's say 200 to 300 trades, for example, over a long period of time, one trade should not matter. All you need to know is that you've done your full analysis fundamentally, you've done your technical analysis, your relationship analysis as well. Now that we've seen how to use equities in Forex, we're just going to move on to the next topic on how to use futures in FX trading. Thank you for joining me, and I'll see you in the next one, guys. I'll see you in the next one.